you. Thanks for coming this morning, everybody in person, everybody online. We appreciate you taking time out for us.
We're gonna learn about chip reverse mortgages and what we can and can't do and what special powers you get to bring to your clients and go from there. So I'm Keith of Mingy, work for Premier, and this is Kathy.
Yeah.
Super.
Yeah. Well, super. Thank you. And again, welcome. So do you want to flip? We're just going to cover, I know everybody knows. If you don't mind keeping your phones on silent mode, that would be great. I completely understand we're all running businesses and I know you have to react to things. That's no problem. Please, this is informal. It's meant to be interactive. Ask questions at any time, okay?
Yeah.
If you need to ask questions, go ahead. And then give us your feedback. Love to hear what you thought of our presentation. We looked at the information. Maybe even our delivery style. I tend to wander, and I've done that since I was a kid, so be everywhere. But all right, roller. Do you want to cover what we're going to talk about?
Yeah, so we're going to talk about what is a reverse mortgages. Who is it for? It's a very niche product in general. We're also going to cover how you can use it for real estate investing, certain strategy around it. And then what it compares to versus like the traditional methods and whatnot. We have a couple of case studies and we'll have some key conversations. Maybe so far. Straightforward, great.
That was the hardest stuff. Yeah. All right. You want to?
Yeah.
You want to talk about what a reverse mortgage is, or?
Sure. So it's basically a loan, like a mortgage, except it's the end of it. So it's a mortgage that you do not have payments for. So what they do is they base it on your age, your location of the property, and its marketability, and then that will spit out a number. That's what we'll get in terms of a mortgage. You can get it in a couple of different methods, where payments each month or a lump sum amount of money. Ultimately, there's no payment, but the amount that you do borrow will grow over time. And then, well, if you pass away, what will happen naturally, same process as selling a house, whatever the equity position that is remaining will go to your loved ones and so on and so forth. Any questions still?
So unlike traditional mortgages, this is an equity product. Traditional mortgages underwritten a little different, where you have to qualify differently, meaning you all know the words total debt service ratio, gross debt service ratios, unqualified. This is not that at all. This is all based on the equity, your age, and your property. Okay. Yeah.
You speak it to the low.
Sure. Oh, that's right. Okay, I think Guy covered a lot of this, but this is for borrowers who are 55 years older. All borrowers, so if you have partner spouses, have to be 55 and over. Do not have one partner or spouse who is younger. Okay. Any questions? Sorry, I thought I just heard a question. Don't want to get ahead of myself either, but again, we talked about the debt service. We do not debt service these mortgages. Maybe I'll step aside so you can see the slide. Sorry, bad habit. The loan gets repaid at 3 different stages. Either somebody passes away, they sell, or what was the third one? No one wants to move, or if they just choose to. You can choose to pay it off at any time that you want.
And there's no penalties.
There is no penalty whatsoever. Yep. Well, actually, it's a no to that question. Could be depending how far you are into your term. So I shouldn't say no. There could be a penalty. And they depends on what product. So Chip Reverse has actually several different products that they offer. So we're talking sort of in general about Chip Reverse areas. Okay. But there is different products within Chip Reverse. They offer homeowners depending on what stage of life that you're in and what the need is. Okay. So to break that down, we would be here for a month, which is fine if you want to come every day. It's available only on your primary residence. That's the other thing. Okay. You are not able to put a chip on a rental or a non-owner occupied unit of any kind. Unless they change something that I didn't know between days today. There is legal fees to set up a chip reverse mortgage. Every chip reverse mortgage requires an appraisal. And the borrowers have to get independent legal advice as well, which leads me to a lawyer side. So we like to manage, control, what lawyer a borrower uses when we do a chip reverse mortgage. For the purposes of the documentation and understanding the product, a lot of lawyers out there have never done one. And all of a sudden, the independent legal advice turns into, don't do this. They're going to take your home and you're never going to see another lots of equity in your property. And that's not the property. That's not it at all. Chip reverse mortgage, you own your property. Nobody else owns your property. You retain title, everything. So making sure we're working with lawyers, understand the product and what we're getting into is really, really important. Okay. Now, having said that, if a borrower wants to use their own lawyer and the lawyer's never done a chip reverse before, we can absolutely, between Chip, the company, and us, help the lawyer out with all the mortgage instructions. Okay. Do you want to be it? Station, Molly.
Oh, there you go.
Sure, Kathy, sure.
I know, right? He's pointing at me.
Well, that's fine, it's fine. We're gonna,
Oh, sorry, point.
oh, it's over there, okay.
New rooms, we've never been here.
Yeah. So it's just pretty much certain ways you can unlock the potential equity and what you can use it for. Well, if you have the older folks that are this is paid off, their kids are in a situation where they can't save their down payment, can use a chip goal.
Right.
You know.
Yeah.
Okay.
You just,
Yeah, if they can use a chip reverse mortgage to gift the down payment to their kids so that they're able on the back end to go and purchase a property. A lot of cases, some retirees will use it to debt consolidate because their pension income, their or like money coming in isn't it's great. And sometimes they get in trouble with debt. So they'll use it to pay off debt. And again, they keep a large portion of their equity. Yeah, no payments, and then they can pay it over time whenever they want. Renovations, grades, if you want to use it to improve the house so that you can sell it later on, is also a strategy. And you can use it to acquire property. Of course, you can use that equity if you're super equity rich, buy investment property afterwards. And yeah, then build wealth that way as well.
just, I think you touched on it, just for clarity, as I said, you cannot put a chip reverse mortgage on non-owner occupied.
Yeah.
That's not what we're suggesting for sure here. What we're saying is the equity from your primary residence, you could take it, go buy property. This is kind of leads into a little bit about what Glenn was talking about in your business planning session is exactly that type of strategy. And there's a couple case studies we're talk about here that will also be well, you'll be able to relate to in terms of chip in your business.
So there's very specific reasons why you can use it, and there's very specific reasons why you cannot.
Exactly, yeah.
Yeah.
Because it's not like a blanket,
No.
let's pull money out and do whatever we want with it.
No,
Yeah, but if it's on your primary residence, what you want to take the equity for, it's up to you, and how you want to disperse it is up to you. If you have your primary residence, and let's just use you have no mortgage. Let's say we can put a $500,000 chip on it, then and you take 500 out. You want to take that 500, invest it, go on a wild vacation, buy a sports car, or buy property, go for it. You want to be free and clear, or take that money plus any savings you might have, buy another property that is not owner occupied or a secondary use home that you can.
another thing they so always want to make sure of is like at the time of passing, mortgage cannot exceed your equity position.
Right.
So it's also part of the reason why they calculate your age, the geographical location of the property, and its marketability to make sure that you always have enough equity. So you can go up to 55% If it puts it in a situation where like later on you don't have equity, they won't necessarily give you like, for example, 500K or
Does the property have to have no mortgage on it, or can you have?
No, yeah. I was gonna try and show you a live demonstration of the actual calculator.
Yeah.
I'll have to talk to it instead, one of our case studies, but we don't know the algorithm of their calculator, but it will tell us. And anybody go on Chip, reverse, chipadvisor.ca, go into the calculators and play around. Does not assume any mortgage. So that is literally the estimated equity we get. When you did have a mortgage and at up to the 55%, that's what you owe, plus your equity would be, the net would go to the borrower.
So it's 55%, it's not 5%.
So it's 50, it's up to, so I'm gonna say it's up to and 55%. So the answer is both, because it depends if you owe money on. And there is a common question that we get is, would they consider more, like, could you go to 60%? I'm not gonna promise you anything. There are exceptions to every rule, and for the right exception, right property, might consider it. I did do one, it was $1.5 million value property, no mortgage on it. And it was on a lake, beautiful, blah, blah, blah. And we actually needed like 59% to make it work. This was for 2 retired people, very limited pension. They moved from Ontario, bought this $1 million property, would never have done it. Couldn't pay their property tax bill. They didn't make enough of that income from their pensions. It was really sad. So we did a chip reverse on, and they're living large, like they're good. It's like and he was very ill. So again, no money for anything. And some of the adaptations they needed for their property, they couldn't buy, like a shower handle, things like that. So it worked out really well for them. And we did go 59%. So
Curious about, so I'm thinking like in particular, like of a senior person who wouldn't necessarily want to stay in their home, but maybe there's something else that they want to do. So there's an improvement to the property, or they want to help out an adult child to get their first home. Whatever the situation is there a mandate or a condition under which have to maintain the property to a certain level to maintain that equity? Because seniors over time tend to let their homes kind of fall away a little bit. So just wondering.
it's a great question. So for anybody who knows about mortgages, when a mortgage is registered, they're registered as standard charge agreements. And any standard charge agreement, if you want to go on property online and read your standard charge agreement, it says you must keep your property in whatever condition, blah, 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 blah. Yeah, all the legal jargon. In answer to your question, it does, but it does for only that's property that you have a mortgage on. That's a lender requirement. You're also not supposed to do renovations to your property without letting a lender know. Like seriously, like I've done more renovations to my property. I've probably rebuilt my house a couple times, but never would I reach out to my lender and say, hey, I'm gonna paint my bathroom this week. Are you okay with it? Like it's ridiculous. Now, nobody sue me for saying that, but you really that we're all supposed to keep our properties up to whatever the standard is in the neighborhood and all the updates that you need to do. Yes.
So with that in mind, in order to qualify, would an appraisal be triggered in order for them to qualify for that?
yeah, there's always enough.
Always, yeah. And even there's deficiencies. So let's say the property isn't good, maybe it needs a roof or something like that. CHIP is not unlike any other lender. On the equity, they could condition, hold some back that's done. It's really pretty easy to get along with. So for them, it's all about sort of reverse thinking. They're not thinking about the whole, they're thinking about their equity, thinking about the risk that they're taking.
Yeah.
If they had to sell their property, are they going to get it back? That's what they're thinking.
And you mentioned earlier that you do calculations up front to make sure that that doesn't happen. You're not upside down.
Yeah.
Exactly.
And we know that it could happen. So if it does happen, and let's say the borrower is still alive and the chip now is worth, their payback is way more than the house is worth. Is there, so we still stay in the house and no one gets it on the
Yeah,
house?
exactly.
And what happens to the remaining balance owed on that?
Yeah. So technically, that's where the lender takes the risk on that.
Okay.
So their whole goal is the house is worth more. Obviously, they have their percentage that they would tack on each year on the property. And it's where they make their money, right? On the growth of like that interest cost. Now, if they made a bad bet and the interest cost outweighs the equity, then that's on them. there's no payments, right? So that's really on the, yeah.
But on the sale of property, if we assume that a senior's living in it and they're trying to maintain their lives or pay the property taxes.
Yeah.
Just to be able to survive in the home
Yeah.
longer, and then obviously something happens and there's nobody else on title, or maybe even if there is somebody on title. If there's nobody on title, what then happens to the home in terms of a sale? All that go back to the lender?
Would fall under estate line, so if they died intestate, meaning no will, or does it have to go to probate? You know, it depends if it's the government's estate at that time or family estate. It would be done through state lawyers.
And probate.
Yeah.
whatnot.
But ultimately, Chip's gonna be looking to get their money
Oh,
back out of
Yeah,
it.
yeah, yeah, they're gonna try to cover it.
Yeah, and they're gonna give, hopefully it's a family estate, like there's children or somebody running the estate, some sort of executor. They're going to give the family time to sell this property. It's not gonna come along and say, for sale, we gotta get it sold, we want our money. We're really sent to work with, so.
And if the sale of the property doesn't cover what's owed for the chip, is there a repercussion there that the family has to absorb?
So, you know, that's a legal question, I'm not sure. That's a lawyer.
Step in if there is one.
I
but-
would expect we would, but I don't.
Yeah,
When it's paid back, how is the interest? Is it price of each year being added on kind of thing?
Compounded,
Compounded?
yeah,
So it could be
absolutely.
a tremendous amount of.
Yeah, which is why the 55 rule, because they need all that equity. And so their calculators, their algorithms, their calculators are built into market values for in the future. Like, again, I don't know, but, and you know, the market, they're always looking at the market. So that's why that 55%.
Their goal is to never allow you to essentially
Mm.
hold that money on the back end, right? So like, yeah, sure, let's say the property is like million and then there's 500K that you can technically borrow. They might make you borrow less, like a 350, and then calculate, okay, how long will this person live, XYZ, and we should be here, and then this equity portion goes to family XYZ. So it's what they would rather do than just, hey, here's 55% and then giddy up, right? And we'll figure it out down the line. Yeah, yeah.
Well,
Yeah.
you're right. I mean, you know, it's funny because, not funny. They, now that I'm thinking about it, working through one of my last ones that I did. We took, like the average interest rate for CHIP is between 6 and 9%. Even if we took 9% based on the money they want to borrow, and we compounded that out, we amortized it out over the next 20 years. So let's say, person we're talking about 70. We're really thinking, sadly, we're hedging. How long are they gonna live? So we look at age 90, compound all that interest going forward. What would that look like? So
Yeah.
what would the balance be at that time?
Yeah.
So that's what CHIP is doing with all of their, calculators and their, exactly.
And then they're also accounting appreciation of the home as
Exactly,
well.
We've never heard of one in any situation where we have a loss. Never, well, maybe they exist. Nova Scotia, I mean, for sure that.
Even if it was, when you look at over time, chip payouts they're getting when people pass on or estates get paid out,
Yeah.
their interest is covering any loss. I mean, they're always gonna win.
Exactly, absolutely. Yeah,
Right.
yeah, so.
Otherwise, they wouldn't be around, right?
Exactly.
I think it's, maybe I'm making this assumption, but if you do a chip mortgage at 55 or 56, you live to 95, you could theory hold them for what money. Well, your state does, yeah. Well, right, but if you want to.
No argument with that.
Help someone or to write for down payment for someone or what have you. I can up my mortgage. Sell my house.
Well, we worked so hard to build this equity, so you want to
But-
ask, to get here, so.
Yeah, so I was just thinking like for me, with them kids, like, it would be like that's part of the estate that's gone. Yeah. Right,
Yeah, yeah.
and it's gone. So what you have, if you're accumulating the cumulative interest over 40 years.
Yes. I agree, yeah.
Keep in mind,
Right, yeah.
fine, they say it costs you $250,000 per kid to raise them. But subtract that from whatever you borrow from your chip equity. I think you're owed it.
Yeah.
But here's the other thing,
I'm kidding.
this is a very niche product at the end of the day. 55-year-old, the way I would look at it is, okay, they're still working. They still have a lot going on. They're not on pension income. This is really like for really equity rich people, right? That really want to help their kids. And maybe you don't want to use your own money. I don't know, right? So what I would do, I would just refinance your house, give you the money, and then you can still pay it down at that age, right? So again, very niche circumstances that, you know,
Yeah,
We could give your kids a leg up.
Yeah.
Yeah, I'm just thinking, in theory, worst case scenario,
Yeah.
right? Like when you're having these conversations
Yeah.
with clients, because a client is often gonna go worst case scenario,
Yeah.
what about this?
I agree. Yeah.
So it's just having all of that information to be able to say,
yeah,
this
Yeah.
is the worst case. Like, so if you're okay with the worst case, you land anywhere in between, you're fine, like
Yeah.
your goals.
So this is a solution to a very unique problem. However, you have to figure out what those inherent risks
You have
are.
to be okay with
And
all of.
you need to be, embrace the suck. This is the
Yep.
potential suck of this. Are you okay in that?
Yeah.
And if you are, then let me connect you with somebody who can talk to you expertly about this.
Yeah.
And now you're open to that conversation.
Exactly.
and back to those but you're on, sorry, because back to those amortization schedules that I took. We don't just slap chip on a property for somebody. We go through a certain process and discovery and understanding, and we show them those schedules to say, hey, if you had this long, this is what you're going to owe at a certain point. That amortization schedule is long. So at this point, you're gonna owe this. Would you want this for that long? How's that gonna affect your estate?
Yeah.
The estate planning sort of combined with smart, yes, because we just can't slap it on and then send the customer in 20 years later goes, oh my God, I have no equity in my kids, for example. Well, we do that up front, so you kind of plan for that. And again, it's case specific.
Does the initial interest rate stay the same throughout the whole chip, or does it get?
Gets renewed. So the average 5-year, depending on which project you choose, that between 6 and 9%. I know it's a wide range, but and they'll price it. It's actually 6.9. Sorry, they'll price it when we apply.
It's not based on the new value. That bucket. Or is it based on the new
Based on whatever the rates are at renewal, just like any mortgage. Yeah.
balance?
Yeah. And there'll be a increased balance if you're not making payments. So you can actually make principal and interest payments with the chip if you want, buy to, but it depends on, like, some people are so wealthy, they put these on because it's different
So,
means for
Hedging,
equity.
yeah.
It's yeah, exactly.
It's
So,
other people's money. People with money don't just their own.
exactly.
Right.
Clearly don't operate in that world.
Right, me neither. Exactly. So the case studies, yeah, okay, so this first scenario, one thing we didn't mention yet about the reverse mortgage is, or chip, is that it can depend on, or the amount can depend on whether we're male or female, single applicant, or joint applicant. Yes, and of course, age, obviously, is the other thing. So in the first scenario, we'll just calculate this based out on a male who wanted to purchase a rental property, wanted to use the equity in his home for down payment. We'll call it down payment / rental property free and clear. Well, he's young at 55, scenarios in this case, he has no mortgage on his property. So he's able to take out 152,000. And he's putting it towards a down payment on a $500,000 rental, or can top it up with his own funds and buy it free and clear. For this purpose, we're just going to say he has a mortgage on it, on the rental. The duplex that he's buying generates that $2,000 a month in income, or per unit, so $4,000 a month, sorry. And the duplex mortgage payment is somewhere around, I thought I put it in here. It was like $2,100 or something like that if he puts a mortgage on it. But as you can see, the rental is going to be very cash rich for this person. So at any time, if you want to build a story around this guy, he's got lots of investments but didn't want to take any money out. So we'd rather have a rental property that you can use as a write-off, or percentage of it write off every month while generating additional income. Doesn't owe a lot on his chip. Pay that off at any time, doesn't matter.
Yeah, or use his own income.
So the reverse mortgage amount is only about 21% of the value.
In this case, yeah,
Yeah,
Yeah.
so that's just because of the appraised amount and.
Yeah, yeah. exactly. So, well, you don't have to take 5%. You take what you need, depending what your strategy is. Okay?
And how many times can you do that?
One time.
Only
On
one
the
time.
owner occupied property. Now, is if you were making principal and interest payments and paying it down, there might be an opportunity to go back to SHIP and ask them to increase it or take more equity out, re-advance, as they call it. Yeah. If you sold the property, another property, it's there, and you want to do it on your own occupied again, they would consider it.
But if you're gifting money to a child, you only do that once.
Yeah.
If you were gifting it to a child and they were gonna buy a property
Yeah, you can do that, yeah.
to live in, that's considered owner occupied?
I guess the other thing too, if you're trying to give to your child and you have multiple children.
Yeah.
You would only give them, the, potentially the minimum down payment for the purchase that they're looking to do, right? Let's say your chip reverse mortgage was for X amount of hundreds of thousand. Just take what you need, you don't need to go and max it out. And you can re-advance it again in the future to, yeah, because you're way under the limit, right? So.
Okay, so you could take that limit.
Yeah, and then that way, you're not like 6.5% immediately off of a larger balance,
Yeah.
you can just,
If you had like two
Yeah.
kids, one was ready to buy something, the other one wasn't.
you got it. Yeah,
And assuming that you're repaying as well.
sorry, there's two.
No, I got it. Go ahead, Grant.
Yeah. Okay, go ahead.
No, I was just saying, so you can only take it once, you said, but that's if you take the max.
Yeah,
If you don't take the max.
If you don't take the max, you can
yeah, you can split it however amount you don't have to go.
pool you can pull from.
Yeah, exactly, yeah.
And that would potentially shift with the market, assuming that
Could, yeah.
the equity
Appreciate
value, like the way we've had this market.
Yeah.
Okay.
Yeah.
So a couple of hands.
If somebody's 55 years old or 56, do you give them 55% of their equity?
Like,
If they,
I've-
if they wanted it.
yeah, it depends on what's going on and why, right? It's sense and, it's more of like a very strategic scenario.
I'll tell you what, I
Yeah.
think, the slide, that the next one.
Yeah.
First.
Right, okay.
I think it'll make more, it'll come clearer here
Yeah,
shortly.
okay.
How about that? Because it is about
But that's a big
options.
to give somebody 55% of their equity. But live another 4 years.
Again, it's very niche, and again, they won't give you 55% probably because you're 55 years old. We might give you, I don't know, 35 because you're so young and then so on and so forth.
Like 6 to 9% interest over 40 years.
Mm,
Pretty good return.
Yeah.
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 You'd be better off
Yeah.
higher money on your own mortgage.
And I think depends on what the strategy is behind or wanting to do it at that age and what investment is for.
if they do a repayment as well.
Exactly. In this particular scenario where Kathy just showed on home 700K, I was my client. Yeah, we go purchase the rental does its own thing, but with the income that he's currently making, use that to pay off the chip reverse. That's what I would do in that.
There's
Yeah.
an actual form that's called cash scamming.
Yeah.
People do that on your return before, where you actually have your tenant pay off your primary.
Yeah.
Nice little gig to do it.
Actually, I will correct what I said. Yeah. I will quickly correct what I said about this area. That 150 is used towards investment, right? So you get a tax write-off for that. Technically, I would use his own income to pay off the rental.
This is
Yeah.
free cash, like this is tax free. Great, so if you can take tax free income and. Or double or triple or whatever, depending on what you're doing.
Yeah.
It's a solution-based product, it's not for everybody, like you've said many times, it's a need. It depends.
Yeah.
It's a fit for some, not others.
Before we leave this slide, can you please explain why male and female?
Yes, thank you.
rates different? Yep.
Women
Live
live longer.
longer.
It is.
Pretty much.
And they're smarter.
Although it's just you to say.
I don't.
We have.
Some life live longer.
Exactly. You know, this one is just really simple. You probably read it already. This is one of those cases where this little person, 70 years old, had on her own, no, the pension just didn't cover the expenses. And so at her age, doing this allowed her to live, enjoy, keep the house up to date, and, you know, live life, you know. Basically, staying in her home, not having to go into assisted living or something else.
Yeah.
But why does it say male would be up to 213 if the female was getting 195?
So these based on, didn't put, for the female, I didn't put up to, I should have, so I left it out. When we go into the chip advisor calculator, it'll give you a base and then up to, so I left the up to out, which was higher.
Oh,
Okay, sorry about that, yeah. That's what I was hoping to do in a live demonstration, but I can't. Jessica set up here, so. Anyways, again, tax free, great.
So this is to stay in the home.
Yeah, this would be a person who wants to stay and
So it
retire.
does not apply for somebody who wants to turn around and sell it.
They can still sell it, yeah.
We're rolling.
Yeah.
This is a great one. It's probably more.
What's
specific.
what's the payback? So soon they sell, let's follow what was just saying about. They sell, so then what happens to the reverse? They get
So,
paid out?
yeah, the reverse gets paid out like a regular mortgage, whatever
So as-
the percentage they collectively got over time, and then the remaining amount goes to.
So
That
they have a
us?
regular,
Yeah.
They become the first creditor, do they not?
So, yeah, like, yeah,
They-
would be the first creditor, they get paid out, and then the remaining goes to.
Canada.
They do not, CHIP does not allow second anything registered behind the first.
You can get a good lender to put something behind it, you can't.
so if they already have a mortgage on their property. Does the chip mortgage take over that mortgage
Yeah,
then?
exactly.
You're paid off.
So is this something, so if I did this, I wouldn't be able to do it through multiple lenders? With this whole different, like,
So like any lender, if you were to move your mortgage to another provider or the same provider and you do a refinance, and let's say your refinance is for 80% of your property's value. Let's just pretend this 80% is 100K, and we have a mortgage of 100K with this main bank. The bigger loan to eat up the old loan, whatever's remaining, the 300K goes to you, right? Be the same thing on the reverse side. So if you already had a mortgage elsewhere, this bigger loan would eat up the other one, and whatever's remaining goes to you.
what lenders communicate.
Oh, yes.
Yeah, they have to.
We see everything, like really, I know it sounds funny, but we see what's registered on properties. Time when we talk to customers, we ask specific questions about HELOCs are the biggest, makers, so to speak.
Okay.
We see a lot of credit bureaus that show large lines of credit, but they often report it as unsecured. So we take a deep dive on that.
Yeah.
We check property online to see what, we look at ownership, we'll look at what's registered on your property. Yeah, and lenders see more. So we only have one version of a credit report. Lenders have a deeper credit report that they look at. It's different hours that they can see more on.
Exactly, like especially with Scotia Bank product, because they love to do this thing called the Scotia Bank Total Equity Program. Essentially, you got your mortgage, and they'll link all of your equity to lending product like credit cards and like lines of credit. So the naked eye, I will see, okay, this is just a mortgage of 200K, for example. And Scotia Bank went in like a credit card of 20 grand and then a line of credit of 50 grand. Technically, this mortgage in total is 270, right?
Mhm.
And then, so then when I go to pay it out, I might not have enough if I'm thinking, okay, it's only 200. But what the lender will see is like, no, 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 this is all together. You need more money to wipe this out. And the going part of Scotiabank is those products would have their own interest costs and then obviously the mortgage. But one pretty niche lender that only does that. But yeah,
Things that, I'm not sure if you were asking this as well, but about the providers, Chip is like the Cadillac of the reverse mortgage. They're the originators, etc. There's other lenders out there that do sort of a version of it. Royal Bank does, never done one, Home Trust, and then you've got Manual Life and some of these other lenders that do something called equity lending, but none of them, except Home Trust product and Royal Bank, have a no payment option. This is one of the key things that people love about Chip is get money tax free. There's no payment.
Interest payment, nothing.
you'll see, you'll see.
Yeah.
Sure.
Yeah,
Yeah.
just delaying. You're really deferring and delaying it, but the whole point of the program is to do that, really. And that's why we keep saying it's niche, like it's not for everybody type of product. So this is the downsizing one we were talking, sort of, I thought maybe more relative, or we thought more relative to what you guys might want to use it for. And actually I have two things I'll tell you about this. I'll close up here, I'll remember, and talk about you guys. So in business for self, we're all business for self, commission income. We know our income can ebb and flow depending on what's going on in the market. Sometimes there's long, where we don't have the income. Again, if you're in a position that this is something you would want, you can look at a Chip reverse mortgage to raise capital for yourself. You don't have to draw it all out at once. You can do partial draws if you want with Chip to subsidize your income. Hate to use the word, but in economic times that aren't always favorable, how's that better than slower times? There you go. Because we all face it. So you don't have investments to draw on, or you don't have a partner or whatever. It might be an option. So it's food for thought. So you know it's available.
Their percentage is only paid on what you draw.
Yes.
Yeah.
Or yes.
Yes.
Yeah.
They said it was a one-time,
So this, yeah.
Yeah.
so you take it and then you can take it.
And the reason, yeah, and sorry to confuse you, because you're right, but they have a product, well, one of the ways you could set it up, you could take a lump sum all at once, so you take the 150,000, for example. Or you can say, you know what, I want to take it all, I want to take 10,000 now or 20,000 now. Sort of sits there waiting for you almost, and then when you're ready for another draw, if you ever are, then they'll let you do another one, up to your 100.
Yeah. Or-
They determine the amount
Yeah.
that you can.
Or don't they also like amortize the total amount and then you have
Yeah, they can do that too.
Phase.
Quite a
Yeah.
few options, but like I said, if we, I mean, hey, I'd be happy to do this 3 times, we can keep breaking this product down. We would be here for a good week, because there's so much to unpack with this product, so trying to keep it simple.
Some of us are gonna wanna dive,
No, it's fine.
just so you know. With the idea of doing this, you have to get reappraised each time,
Yeah.
so another process, or
get
once you're
appraised
appraised, that's it.
figure out about
Yeah,
Basically,
this is your limit.
Great way to look at it.
Take as
Yeah.
much as you want.
okay, no, and that's good to know, especially again, senior, I'm thinking of that home, and the home's in pristine condition at the point when they go through this process, but then over time, maybe not as pristine. They've already been qualified for a bigger amount, so okay, no, that's,
It is not a product we set up in 2 weeks, just so you know, it's about 30 days end to end. At this done application to funding, it's not quick. So, to sizing. Or again, yeah, I think you probably already read this, but again, if you're somebody who's older, wants to sell, doesn't want to be committed to selling something and buying like subject to sale, and says, you know what, too much, I just want to get into a new home, I don't have the money to look at a Chip reverse for them, take the equity out for their down payment, maybe in some cases it'll be absolutely buying the house, new house free and clear, we don't know until we look at it. And then they can sell later. This takes some of the stress off, seniors especially, who might want to consider sizing. That's where I think the real niche is, and I think what I was trying to express at the meeting.
using it like a bridge loan, sort of.
yeah.
But like I said, keep in mind, when it comes to condition of financing, you don't want 40% Yeah, making an offer, accepted it in days to get a chip, it won't happen. You'll be so mad at us, it's not happening. So they can't work that fast.
Better to have it done.
Way to take.
Yeah.
Absolutely.
Especially if yes, like you can have a super long closing and then set up the chip and then. You can.
So
do
there's no
that.
guarantee of what that actual amount would be.
Well, like again, within the first 2 weeks, we will figure out what that number will be.
So minimum 2 weeks to even ascertain the number, full 30 days,
Yeah,
probably.
Clarify.
Exactly.
So the
Yeah.
borrower has the money to say, yeah.
Yeah.
You can write an offer on property. Whether it's a down payment, but buy it free and clear, whether you need COF or you don't need COF, ask for that.
yeah.
And if you're not sure, that's what we do every day, ask you. Just ask, we can help you. You position it for borrowers.
Are there additional fees and so on? It's like, so if somebody was doing it to downsize and they had the chip for, say, 6 months or 8 months. Is it worth it to do that? Or huge-
Yeah. So like any mortgage, they have different terms. So if the house is gonna take 6 months to sell, take a 5-year term. Right? If the house is gonna sell relatively quickly, we take the term that makes the most sense. If it has any sort of penalty, we handle that at that point, but ultimately, yeah, if we take a slightly longer. Yeah, you put up that, yeah.
No, I haven't checked the chat.
Oh, yeah, right.
Sorry, guys. I don't know how to.
Oh, chat's good.
That's good.
Yeah.
Okay, so I think we can move on. Here's what we want to talk about.
Yeah, so this was my example on 450, but it doesn't matter. So essentially, let's say you got a chip reverse mortgage on 450, and it was a traditional HELOC. So a HELOC is a line of credit. One thing with line of credit, you're only paying interest only, and that technically means you're paying not to pay. So you're just extending your payment for long in the future, right? So your payment would be like close to $1,900. If you did that same 450, a conventional regular mortgage, your payment comes up, as you can see, by $500 because you have to hit that principal as well, right? So over a amortization of 25 years, is the example here. And then if it was a chip reverse, you took that 450, that's zero, right? So especially in the case where they're trying to go buy a rental or anything like that, it's sitting at zero. So there's no payment there. You can do what you want with the rental income that you collect, right? Another thing too is if you were utilizing a strategy where you would implement two things at once, so you would have the chip reverse, which the payment is at zero, and then you go to buy a property on the back end. You do have to qualify the traditional way. So ideally, yeah,
I don't know if this is off topic or not, but it just hit me. If I have 5 properties,
yes,
I'm over 55. And like, I'm pretty sure you can take a HELOC out on each of them.
if you
Do
qualify.
a Chip,
No, you can only have a chip reverse mortgage on your residence. Yeah. 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 Like for the people that have pretty strong pension income, and there's different sources of income in retirement, they just want to get chip out to, as a down payment. The other lender's gonna calculate, okay, like based on your chip reverse mortgage, yes, it's an open loan. This is what we will use as a qualifying payment, and then versus your income, and they'll figure out what your max buying power would be at that point. But yeah, that's
And presumably they calculate in all the other income debt ratios for all the.
exactly,
properties,
yeah,
for all in.
yeah, exactly.
So remember back to, I think, question or generally the questions around how do we pick the products for the person, the borrower? We don't necessarily pick it, we want to present options. And we typically would run through these 3 options and show them the compound schedules and help the customer come to a conclusion on their own about what might be best for them. And keep in mind, they've got a reverse and then you decide, no, a couple of years in, I don't like this. Go back if you qualify to traditional products.
Yeah.
Go to HELOC, back to refinance of any kind. You know, again, sometimes it's about what's the borrower's intentions, why, for how long, and if it's a scenario, maybe they're waiting for somebody to retire and then they'll have that additional income, they don't need the reverse, who knows, maybe they're doing this short term till they get back to work, who knows what it is, you know. Lots of,
So it's totally based on your equity, like, so if I have a mortgage rate now of 100,000 with RBC on my home, and I get a chip, I still have that mortgage of 100 grand with RBC.
and maybe-
No, no,
That's what I was
yeah,
wondering.
chip,
I thought you
chip,
said
yeah.
that. Okay, and it has to be paid out at the high interest rate that you. Oh,
No.
how does it get paid?
So essentially, RBC's over here, Chip wants to be in first position, so it will wallow the RBC mortgage side of its total amount there.
So the total chip is
Exactly. Yeah, exactly. Yeah.
yeah,
Okay.
yeah.
Yeah.
Yeah. And again,
That's when you sell.
So that would be like, let's say you already have a mortgage and you wanted to move it to a chip. That's what I was describing
Oh,
there.
I see.
Yeah,
The chip has to be in first position. So the chip
Only
will go,
position.
Yeah,
the only position, so that if there's another mortgage, the chip will
Yeah.
pay.
the
Well-
problem with the other mortgage along with a chip, it would just mess up the equity calculation. Chip in general, right? So,
Okay, so if you were getting 200,000 on your chip.
Yeah.
Like that's how the calculation came out.
Yeah.
But you had $100,000 with RBC.
Yeah.
Your chip still two?
so total amounts to, they pay out the 100K of RBC, you get 100.
Oh,
Yeah.
so they deduct your existing
Yeah.
mortgage from the amount that.
Yeah.
Little chip 200, you check on it.
Yeah,
Right.
So it's really just for people who don't have a mortgage.
Ideally.
Depends on the scenario. Yeah. And the value of the house, like in Ontario, you could have a mortgage and like over there, like it's actually Wild West, like you'll have mortgage 400, 500, 800K and then the house is worth 3 million.
But it also could be consolidation of third homes.
Yeah, that's,
Well, as
yeah,
mortgage. So if you're doing a chip mortgage, then you could end up with 50 grand. Because it's consolidating.
Yeah.
Your mortgage, your line of
Yeah.
credit, whatever it is.
you would use it in scenario where like, you would use that scenario if you were very, like your pension income is just not very strong. And then you start a bunch of debt and you're in trouble, you're almost forced into selling your house. You use the chip to pull yourself out essentially and like, stay in the house, right? And then learn from it. Yeah.
There would be some good to it.
Yeah.
payouts,
Selflessness or.
property taxes and you're in arrears.
Yeah.
Yes.
Yeah, right, taxes and you're in arrears.
Still having that.
There's no debts and then you do it all. One more slide. I don't know. Oh, the other one didn't make, you see? We were missing,
So it does that.
that. So things to think about, on this product, again, I think we, this to death is interest rate's gonna be higher on a chip than it is gonna be on right now traditional mortgage. Some people get into so much trouble financially. But one of the other solutions we haven't talked about today is alternative lending. Sometimes we have to go for alternative lending, so we might have people with lots of equity home. Really, you know what, with a chip, would solve their financial problems, have any debts or anything like that would bury them. Without going to an alternative lender, because as soon as we go to an alternative lender, you're looking 6, 7, 8% interest in anyways. So
Plus the
this might
fee
be a better.
Just to get the,
Yeah, it's all relative to, product is all relative to the customer situation. Again, we talked about it confidence over time, we talked a little bit about estate planning, but one of the things about that is the amortization schedule, is that we want to make sure that people understand when they're, you know, where the mortgage could be at in 5 years, or the balance in 10 years, or whatever. So that factors into how much they want to leave their children when the house gets sold for. That stuff we will talk about all up front, which is great. Some people want to take all of this and go back to their accountants and their lawyers, talk about their estate planning, their financial planners. That's fine. We want as many people that may involved in the same conversation. Okay. The last one really is just who. I think we've covered a lot of the who.
yeah,
Who does this apply to?
so,
Anybody over 55. us, equity in the home, and depending on their personal situation and need. Again, we will compare options for them. CHIP isn't the first thing we recommend out of the gate. It might be the last solution, but the best solution for them.
Very equity rich division.
And one of the things we talk about, like your role conversation, is just that, like any other customer, if you get a sense that somebody's like telling you, I'd love to sell my home, but this, you're getting objections. Well, I want to be in the new home and I want to sell this home, as the example. You know what? Start just going, okay, well, let's put you in touch with a mortgage broker and let's see what we can do to find a solution that would be helpful.
Yeah.
And remind them, as you guys don't know, brokers don't charge fees. They're not going to try and get you into something that, where spend is going to come break your arms and legs. That's not, so there's some common myths still out there. And not all, there's a difference between a mortgage broker and a mortgage specialist. And mortgage specialists do not, to my knowledge, to this day, have systems.
There's specialists are bank, right? So they only deal with that one bank's product, right? Yeah, because I used to be one, so yeah.
Okay, we also
Yeah,
bank.
yeah.
And it's not that it's going to the bank is wrong. It's not that doing a home equity line of credit is wrong. It's not that, putting back to an amortized mortgage is wrong. But sometimes the customer just don't know there's more options out there. And I think that's what we need to do. And we are actually bound by our licensing to make sure we deliver all options to our borrower. So
That's actually one of the things that I truly love about dealing with a broker as opposed to a bank. And again, not to diss on banks, but when I have clients who potentially have unique situations or require more creative solutions, it is a much easier conversation to say, I'm going to put you in touch with one person. That one person can talk to you about the entire spectrum of offerings that could suit your particular situation, which is all very customized. Instead of you trying to fit into a product that your favorite bank has, it's who has the right solution for you and who's going to have the best interest rate and who's going to make it easier to deal with, so that we're taking that off your plate, not adding to it.
sorry, go ahead.
Yeah, no, I had the bank when I was there. Like, main goal was like, do they fit mold? And if they don't, then used to. I mean, that's was like, I know it would work next door. So that used to drive me bananas, and while watching it walk away, I'd be like, hey, works over here. You can't go there just because I know their policies. Yeah. They used to drive me nuts. So yeah, now I'm on this side. I wish I had less of that pain. Yeah.
Good. Is there anything you want to cover again, or we weren't clear on? It's a lot of product, like it's big product sort of unload on everybody.
It is a lot. Can you start from the beginning?
There's 2 bits are left. That's not. Yeah, well, yeah, no. We're here to answer any questions. The one thing he and I love to do is educate. So I always like to make people feel comfortable saying, hey, all one of us doesn't mean you have to have it set to us. But we can just educate people, help you educate more customers. Right? Now we want business, don't get me wrong, but but feel free. Like there's
So yeah, we got a question here. So they
Oh.
want to know, is there a minimum amount of time that they must own the property? So with chip reverse now, there's no minimum amount of time. Yeah, as long as you the property and you're on title and you're not a scammer, you're good to go. Yeah.
And it's built equity.
Yeah. Exactly.
Regarding like maybe they don't need the chip mortgage in order to make it downsize, but maybe they still want that chip option available on the downsize home. So maybe their house currently is 2 stories or 3 stories, and they just need to be on one level. So they don't have to, if they're buying a new house, they can still do a chip reverse mortgage to take that money out later against the new house. It doesn't have to be owned by a certain period of time.
You can transfer it through
Oh, so
300 on the one, but then you have to pay it back when you sold. Like, so then on your other one, if it's less smaller and less value, you reapply.
yeah, that's what
Okay,
that.
but so then she can reapply, but you may not get the same amount.
That's.
Because
those are the those about the education side, you have a borrower like that, we can do some pre-work to say, hey, this is what would have been this estimate, so for you.
Yeah.
And you don't have to take a lump sum right away. Some people just want have the regular amount of pay come in so that they can cover their expenses, go on vacation, blah blah blah, because they drained out all of their investments in general. Or it's go ahead.
If you were going to list a house, had a chip reverse mortgage on it, did that show anywhere like been registered, we could see that online? Then, so we figure that out, and how long would it take for the
Lender.
thank you, or the seller to find out from Chip how much they owe, so
Yeah.
we know that they're gonna have enough money. They buy, when they sell this house to pay off Chip and.
That's a great question. So like any lender, if you're gonna ask for a discharge letter from the bank, they have to give it to you within a certain period of time. Most of them will only do it for 30 days because that's long you can project in the future, and then the bond market can be pretty annoying.
You wouldn't get that information for 30 days.
No, you get it pretty quick. It's just like it would just be amortized out for 30 days, which will still give you a pretty good idea.
Oh.
Yeah. Yeah, and then it'll say balances now, and it's very rare to
Because-
drastically change like I didn't
If
see.
it didn't sell for 90 days.
Yeah.
It's actually gonna change a little bit more.
It depends on the bond market, really. And then chip is a little different. It's not like a regular the rate. Depending on when you got your rate, you can have this thing called the interest rate differential. With chip, do the calculation differently. So if you've been in your house for a while and you had a chip reverse mortgage for a while, you're just looking to sell, you wouldn't have it easily. Yeah.
Customers have access to their mortgage balance, and so they get a balance for you at least.
Oh,
Yeah, and from online, you will see it registered under reported interest. So through there, good, see it registered.
Okay.
Yeah. And then like DSET, discharge statement of our, so there's two things. Like you said, there's or get your balance. You get a 30-day payout statement from the lender, and then the lawyer ultimately would do the discharge.
How long has Chip been around?
Be some here.
Yeah.
Oh, long time.
Yeah.
Yeah, but they always were taboo. Everybody thought that they,
Yeah.
that they were registered on title, that you didn't own your home. Not a bad.
Tom Selleck says it's good.
Well, not, well, he's great. Tom Selleck.
Wasn't Selleck, that's
Yeah.
new.
Yeah, oh, well, I'm
Yeah.
definitely getting
No.
one.
Burt Reynolds, that's, yeah.
The other guy with the mustache.
You bring up a good point about the discharge, like any mortgage. I don't imagine, although you go on and see it's recorded mortgage, maybe on online. And,
Well, I always look.
yeah, you want to get paid.
If it's a line of credit, it won't tell you the amount.
No, it doesn't.
No.
The register's collateral charges, which you navigate, but. Is there anything we didn't cover? You want to put more questions?
Yeah.
Anything, or mortgages in general, if there's a question about
Love if you guys came and talked more about bridge financing.
2 seconds, you want to do it right now?
She sounds
Yeah.
romantic about it.
It's the simplest thing in the world. Okay,
Loaded, but.
Two degrees.
it is so easy. Okay, here's the real down simple version. Order to bridge two properties. You have to have a firm sale on your non-subject, all conditions met. Your purchase agreement, purchase making. It's just a matter of how many days do we need a loan? How many days can we
Yeah,
bridge?
you can't have more than 90 days.
Gotta be neat, thinky. Exceptions with that. letter. Okay. You don't like it? Beg for mercy subject. We only cover down payment. Your 1.5% detransfer tax.
We're talking about purchasing two properties at the same time.
Selling and.
Selling and
buying.
That's a
That
bridge.
is
why you
that's
said
the
it.
bridge. It's not. What are
Okay.
you thinking?
What did you?
What were you talking about earlier about when you essentially, with your renters to pay off your primary mortgage?
That's not. Oh, cash scamming.
Yeah.
Cash scamming.
Yeah.
Cash scamming.
I know, there's a lot of results somewhere. No, I totally, okay, so the simple concept is always, so I'm in full disclosure, always consult an accountant on this, as I'm not one. Well, that's a simple version again is. You might wanna take city into your home to purchase a rental property, so now you're gonna have a debt against your very property. Your rent income covers payment on the rent rental and you have cash flow. Cash flow would apply to your personal mortgage to pay it down. Is a
Chip mortgage or the.
Yeah, sure,
Yeah.
sure, anywhere. There is some tax advantages to that. Or I see it more as somebody who doesn't owe anything on their primary residence. And they might take out not necessarily chip here in this case.
Right.
Full refinance to take out enough to buy the rental free clear. They don't have to go through the process of getting mortgage over it.
Yeah.
And then take that cash flow from your rental, pay down your primary loan against your private residence. And then if you don't understand that, right? Accountants are good for this. We could get an accountant or.
There'll be an accountant
Get some
here December
information.
10th on
Yeah.
Zoom only. So hold that question, December 10th
Zoom
on
only.
Zoom. Yes, because I'm hosting it and I'll do.
One of the water mortgages.
For bed, oh, you're gonna do, okay, cause you're doing something on cash damage.
I'm not necessarily cash damming. It's going to be, sorry. 1 hour's up. The cash, not necessarily cash dam, it's mostly focused on incorporation, but I know he's gonna be answering other accounting questions.
There you go.
So
Perfect, yes, ask
Have
about
the
it.
accountant think.
And there you go.
Same guy.
it's Henry Michaud. Awesome. So he'll be, December 10th, Zoom only. Everybody should attend.
Do you go to chat? It's like my boyfriend. This is a little jealous. It's been a lot more time with chat than I do with plans in some days.
ChatGPT.
Yes, all right.
Chat with the girl.
Even what you want.
You and Flynn, Kathy, you.
Yeah, I've been a ton of time there for different reasons, all mostly work related research, but it's great. I don't have any of those things. For any of these terms and stuff, going in chat is spit out a bunch of stuff to you that's really interesting. Well, I find it interesting, but and if you ever want to not to coach you a lot here, but use it for establishing statistics. So if you're going to be talking to somebody about what's the market going to do in the next 69 days, you get more specific with what's, what Bank of Canada going to do? What are they'll give you all these analytics around what they think is going to happen with our economy, which is great for having conversations with customers, farmers, whatever strategy planning that we do with our customers. Post closing, there's all kinds of stuff. And so, one of the things that you can argue, because sometimes we get customers going, but this bank's a little lower in interest rate. Well, if I show you how to actually lower that rate by taking my higher rate, would you like to see the formula? And because well, okay.
To see that part now.
Okay, sure, I'll show you.
Oh, ChatGPT, it's great.
Well, I can do that through chat. That's an old age strategy, but anyways, there's all kinds of really cool things that you
ChatGPT, that's
Internet boyfriend.
yeah, and you can argue. Wonderful.
I use it more for figuring out what my penalty position is versus the other banks. So, for example, if I'm up against RBC, for example, I'm up against their variable rate mortgage. Are they compounding monthly or are they compounding like everybody else semi-monthly? Well, RBC's compounding monthly, so technically they can have a lower rate, but it costs more. Competition. So I'll use that to hedge. Okay, what they doing exactly? That might be a little different. I'll use it too for income, especially because people have some really straightforward on our end ever. So especially accounting strategies and all that, and then I'll just be okay, break it down so I can all this to an underwriter sort of thing. So pretty useful when you know what you're asking. Yeah.
That's great. Creating reports. It's huge.
Yeah.
Yeah. Well, my husband curses me. You're gonna take everybody to go.
Nope, we're just gonna level up.
Exactly. Whoever said that. Yes, I love it. Yes.
This was great.
Thank you. I hope it was informative. You know, it's appreciate you guys a lot, first of all, and all the questions and from everybody online. I hope you hear me. Keep looking over there.
This is a good
No, no,
question.
you're
Is it
good.
public knowledge? What's the asking?
That was about the, that was whether or not you can find it online, the information of the amount of the reverse chip mortgage.
Yeah, you can go to chipadvisor.ca. Anybody can go in and play around with calculators. There's tons of information in there. Yeah,
Yeah.
that is really cool. So, yeah.
Let's see, sorry.
So thank you, everybody.
Thank you.
We appreciate everybody's participation,
Oh, I got
your
it.
time, everything.
Thanks.
I'll say it, you might be the first people. Well, Christmas.
Yeah.
Thank you.
Thanks, everybody.
So, thank you.
Sister.
And eat the donuts.
See what she says.
Okay, because I've only had a few.
See if I can find a little